I'm Shivani Garg Patel, Chief Strategy Officer at the Skoll Foundation, and super excited for this amazing panel and conversation today. At the foundation, we do a lot of thinking about working at an ecosystem level and get to work with a number of wonderful partners in the room and here on the panel today. And that's what the session is about. As you heard, we want to understand and dive into what does it actually look like to operate in and invest at an ecosystem level in the world of social change, and kind of shine a light on what does that look like and what is needed to actually make that happen and why it's important. And at the foundation, why we've chosen to prioritize this approach is because simply the challenges that we're all working on collectively, be it wealth inequality, climate action, health equity, capital access, so many others, the pace of the challenges getting worse, or in some cases not moving as fast as we'd like, it just continues to progress faster than some of the solutions that we get to see and work with and partner with. And hence the real feeling that if we're going to actually rise to the scale of the challenges, let's try to take an ecosystem approach. So that's the foundation's perspective. And we have an amazing set of panelists here today who are going to help us dive into what does it look like. Not only are they amazing practitioners in being asset allocators, but they all have chosen to take an ecosystem approach to their work, and we'll hear why that is and what that looks like. They also happen to all be partners of the Skoll Foundation, so I know their work well and look forward to sharing a little bit more with you all here today. So to kick it off, actually before we go to intros, just to get a sense of this amazing room, how many people are entrepreneurs in the audience, just so we can get a sense? Amazing, thank you. Yes, hands. How many people are investors? Awesome. I see double hands on some of those, which I love too. How many people are just broadly in the ecosystem and see themselves as ecosystem actors and players? And anybody that I didn't name who didn't raise your hand? Okay, well, it's good. I think we have a good mix here. So as we said earlier, there'll be time for Q&A at the end. So please, be a part of the conversation as we get to that part. There's a lot of wisdom here that we'd like to unlock. So for my panelists, I'd love to hear from you all. Introduce yourselves to the group here. Share a little bit about who you are, the organization you're with, and what is the ecosystem that you're trying to shift. And Nasir, why don't we start with you?
Is this on? You guys hear me? It's so great to be here. And Shivani, 5 years ago, you and I first met at a new profit convening pre-COVID, and thank you for your leadership, for believing in me since day zero. And the work you lead and Marla Blow at the Skoll Foundation just does not go unnoticed. So thank you. Nasir Qadree, founder and managing partner at a Washington, D.C. based firm called Village Capital, where I was before. Zeal Capital Partners.
Ecosystem.
They're part of the ecosystem. Proud of Village Capital alum. Zeal Capital Partners. We focus on backing exceptional, diverse management teams. We mean that holistically, that are rethinking the building blocks of wealth, from education to employment pathways to financial inclusion. And now health equity. We believe these three categories are critical to turbocharging economic mobility across the U.S. and at scale of the globe. And we do this through a systems level framework called inclusive investing, a 5-pronged market back approach that allows us to widen our lens yet keep alpha and impact front and center. And so just thrilled to be here, and Philip, it's great to see you too. We go way, way back. So that's the crux of our work.
Hello, everyone. I'm Allegra Stennett, co-founder of New Majority Capital. We are an impact investor that focuses on providing training, but also capital for underrepresented entrepreneurs to acquire and scale existing small businesses. That concept is called ETA, Entrepreneurship Through Acquisition. And our North Star is the gender and racial wealth gaps in the United States, and addressing those gaps by providing this access. And what I always say is that the racial wealth gap specifically, a lot of people don't know what are the components of the racial wealth gap. And so talking about that, 90% of the gap is a result of two things. One, home ownership equating 50%, and business ownership equating 40%. And so we're addressing the number 2 reason for the gap. And I always say we believe the gap can be closed in our lifetime. And so that's what we're working towards.
Hello, everyone. My name is Lyndsay Handler. I am the co-founder and managing partner of Delta 40. Delta 40 is a venture studio ecosystem and a VC fund in Africa. I live and work in Nairobi, and we have offices in Nigeria as well, where we serve sub-Saharan Africa. We do three things in the ecosystem. First, we run innovation programs to help African and female founders innovate with meaningful capital and support. And then we lead investments into those companies, and we catalyze other investors into rounds with us. And then I think the most unique part about our model is we have a team of experienced operators that have built companies to scale, and that team works side by side with our companies for the whole journey from idea to scale, and they actually provide shared C-level services, and they bring their network of meaningful co-investors, of corporate partners to the whole venture building process. And our goal is to actually help African and female founders who are on the front lines of key sectors in Africa that drive income, jobs, and climate. Resilience is to really empower those founders to build companies that achieve true Pan-African scale and exits. And we're really grateful to be partners with Skoll because we have to build the ecosystem in Africa. We can't just write checks in isolation, and so excited for this panel. And I'll just say that before Delta 40, I spent 10 years building a clean energy company in Africa, and we started off with an idea and a product in Uganda, and we ended up taking it into 9 countries across Africa by selling our company to Engie. And I'm really passionate about the partnerships that we need to create with not just investors but global corporates to help all of these businesses really achieve meaningful scale, and through exits we can also create this wealth that goes back into our ecosystems. I think what's been interesting is we all work in a different ecosystem, but we're passionate about wealth creation. And for us, it's about getting wealth back into the hands of these diverse founders so they can help seed the next generation.
Thanks. So Philip Reeves with Apis and Heritage Capital. We are a credit fund focused on employee ownership. So we're using the power of ownership to give workers, normally workers who are people of color and low and moderate income, a chance to own. And so Allegra's point around the racial wealth gap, we're going squarely at that 40%. How do we get a janitor, a plumber, a construction worker to not just work in a business, but to own a piece of it? And so that looks like now 5 companies, 440 families now in our portfolio across the country. And so we're really proud of the work and excited for how we can do that at scale through some of the ecosystem efforts we'll talk about today.
Thank you for the intros. When we think about ecosystem impact, we're not only thinking about shifting resource flows, but how policy is impacted, how power where it exists is being shifted, who gets to be at the decision-making table as it relates to that power is sort of being shifted and reoriented. And in all of the cases of your work, I know that you are all trying to demonstrate new pathways, new approaches, and new models. So let's make it tangible for the group here around what are some examples, tangible examples of the kind of ecosystem level work that you all are doing, and share with us some of the signals of progress that show the so what of the outcomes of those efforts and initiatives. Allegra, do you want to kick us off?
So the first one that comes to mind is one of the first companies that we invested in. An entrepreneur who had a background in insurance, he acquired the first Black female-owned insurance brokerage in the United States. He acquired this company April of last year. He's currently on his 4th acquisition. So how he was able to do that, to your point about the ecosystem, he received a down payment loan from a CDFI. Now, CDFIs have a lot of capital. Anyone here from a CDFI? Uh-oh, the hands are not going up. So CDFIs have a lot of capital they could use for very catalytic purposes. And so my co-founders pretty much, drove this innovation with them to say, hey, you have a lot of capital that can be put to good use that's sitting dormant in many cases. And so he was able to get that, and now he's building. I tell him all the time, like, hey, Geico is going to be calling you soon to acquire this company that you're building, right? And to give an example from progress, now we're working with 3 organizations that are separately looking at creating down payment funds, and some of them will be grants, some of them will be loans. And so, because they see like, hey, this is actually catalytic where we can, we provide training, we run an accelerator, we have 193 alumni, 16 acquisitions, 20 under LOI. We can train these individuals, but we can only move as fast as the capital. And so we need these entrepreneurs to have not only the education, but also the capital so they can close on these acquisitions. So from our perspective, we look at acquisitions $500,000 to $2 million EBITDA typically. So those companies selling at anywhere from a 2 to 6x. And so if you think about it, you're buying a $5 million business, you need $500,000 in a down payment. Most Americans don't have $400 for an emergency expense. So if that's the case for the average American, you can imagine, and particularly the communities of color that we're looking to serve, they will not have $500,000 sitting in a bank account waiting to buy a business. And so that's why we're moving these ecosystem partners to think about the uses of capital in a different way that can be very catalytic and, like I said to my earlier point, fix this wealth gap in our lifetime.
I'll jump in. It's a great example. For us, we have one of three of our categories I mentioned is financial technology, the lens towards inclusion and wellness. And when we first got off the ground, we ran across this company called Isusu. Isusu at the time was literally about less than $100,000 in recurring revenue. And when Mamilo Abbey and Samir Gold met us, we were probably the 12th venture capital institutional firm. And the other 11 said no. And when you meet Wamimo, if anyone in this room, because he is on this circuit, you would just run through a wall. So you're betting, obviously, on the founder when you're this early in the company's life cycle. Wamimo Abbey comes from the slums of Lagos. His co-founder, Samir Gold, also a first-generation American, both are first-generation college students. So I saw a lot of myself as an FG, someone who's climbing the ladder no one around has ever climbed before. So one of the things that's a through line in my investment career is, investing in projects and entrepreneurs that are is deeply rooted personally. There's a lived experience, and you couple that with business acumen as well. And so at the time, this company was the 12 pre, 15 post money valuation. In the crux of the company, for what it's worth, is taking rental payments as a means to, on-time rental payments as a means to increase FICO scores. So we had an interest in finding alternative pathways, alternative ways to increase credit access, particularly those with little to no credit scores. And so the joke goes internally at Zeal is that when we invest in Isusu, folks are going to be going around 10 years later to check your Isusu score. We believe that's going to be the case as well. Because 16 months post that investment, Isusu becomes a billion-dollar company. And that, as any of you know, as a first-time fund manager, not first-time investor, at the time our firm was $54 million in AUM. That's on paper at least, obviously returning to fund a great deal. But so huge market opportunity, obviously. But to your question around how this company is impacting families, underserved families, particularly black and brown families, low wealth communities. These are folks who want to buy their own home, but unfortunately, again, have little to no credit. And so this was, we worked with a lot of housing authorities, the Atlanta Housing Authority, the DC Housing Authority, Detroit Housing Authority, and you couple that with the Stephen Ross related rentals of the worlds and JBGs, and then Goldman Sachs, Freddie and Fannie Mac, these huge platforms. And so that's what really allowed them to skyrocket so early on. And then themselves, again, coachable founders, and the impact is going to continue to scale. And I'd argue not just here in the States, but now they're looking at across the water as well. And so great, obviously, investment, but also a clear impact investment as well.
So the way a normal A&H deal works is it's usually a founder and owner who's trying to figure out what's next for their business. And they have lots of options. They can sell the private equity, they can close, they can work with a search fund. And we're introducing a fourth, which is you can sell to your employees. And we're going to simplify that process. And the outcome of that is now your employees get to own that business that they helped grow and that they know very well. So it's a very clear impact thesis in the fact that those people of color now have, an ownership and equity stake that's giving them wealth. But it's a very great investment thesis in that we now have a workforce in a labor-constrained industry that's bought in on the company and that can create value for us and our investors. But when we look at those deals, I think sometimes you can see the ecosystem part and sort of what it takes to get that done. And so the example I'll use is from Denver, Colorado. So in Denver, we've done 2 deals. We've had an owner who has sort of made that conscious decision not to take the traditional capital markets route, but to come through the Apison Heritage angle and to go through an employee ownership transaction. And so in doing that in Denver, it sort of spurred the Denver employee ownership ecosystem. And so Denver, we have an anchor investor there in Gary Community Ventures. They are now working with the state to build out the employee ownership offering to the point that they're now actually putting in place legislation to make employee ownership a more viable option in the state of Denver through tax credits, reimbursement of expenses, all kinds of things, because the states recognize that this idea could be the thing that helps to solve inequality in our geography. And so everything from the governor to the mayor is engaged. We had a bank, I think folks know the SSBCI program, similar program in Denver, but they've now applied it where if you want capital for an employee ownership transaction, you can get more capital. And so we took advantage of that, and that helped us close one of the transactions. And so
Maybe tell people what the SSBCI program is.
SSBCI was a Treasury program where Treasury said, hey, we're going to give money to the states so that they can spur economic development through lending institutions. And so
This is the U.S. government.
U.S. government back. See, I don't even tell the story the right way. But now you're seeing federal, state, local, all happening. Because again, if we want to see the racial wealth gap, great, we did 2 deals. They're going to be successful. Those companies are performing. One's doubled in revenue, and that's now accrued to the workers, not the owner. That's great. But if we want to close the racial wealth gap, we have to do this at scale. And so we have to unlock bigger pools of capital and use the lever of government to make it happen. And so I think that was a great example of where we've been able to do that.
Well, just building off of that, we need your work program in Africa. We have actually 2 companies in our portfolio that wanted to do management buyouts, but there are really no investors that are ready for that. So we're looking forward to your expansion. I think going kind of to the African market, we were committed when we launched Delta 40 to invest 51% of our capital in female founders and 100% in African-owned businesses. And we're one of the only funds that has hard targets on diversity. I think a lot of them say they invest in women. The target starts at 30%, and it usually ends up at about 10% because and investors will just say there's not enough pipeline. Or the pipe, we don't want to lower the bar. So we really are committed and really do this thanks to the work of Skoll's grant and Autodesk support of Delta 40. We've been able to run these innovation programs where we are casting a much wider net, and we actively do calls for African and female founders that are building companies at the idea stage, so even before revenue traction. And we find we really have to start talking to them and working with them and speaking to them and supporting them at that moment they decide to jump into entrepreneurship. Because if we don't, they fall behind. They can never get to the same Series A or the same Series B milestones if we don't start supporting them from day one. They're always, they raise less angel rounds, they raise smaller angel rounds, they have less support, and so they end up kind of looking further behind. So we've decided we need to kind of start with them from day one, and a couple just tangible examples of innovation ecosystem kind of programs we've offered to get to kind of kickstart these founders is one, we've done corporate sponsored innovation scale summits where we've brought founders working in a particular sector that a corporate cares about. They've actually paid for us to bring these most innovative founders together into cohorts of anywhere from 10 to 30 companies. And we fly them to one central location. We put them through innovation programming. We connect them with early stage investors to start to build those relationships. And another interesting thing is we connect them to each other. And a couple things we've found is that if you bring a couple diverse very early stage founders together, some of them will merge and make a much stronger company with a stronger C team, or they're in Kenya, Tanzania, and Nigeria from day one. And so I think that we were really inspired by this book that an economist named Mariana Mazzucato wrote called The Entrepreneurial State, that kind of, it debunked this idea that in America, there are these sole entrepreneurial geniuses building companies. And it really kind of looks at the data and says Tesla, SpaceX, eBay, all of the Web 2.0, the solar and the EV companies, they have been made possible through tons of grant funding, $500 million to Tesla, low-cost debt, and all sorts of other government programs. We do not have that in Africa. African governments have big issues. They're paying most of it to repay our debt. And they don't have these. So the last thing I'll say is we need grant funding in the early stage to help diverse founders build the next Teslas. And we shouldn't be afraid to come into companies with grant money as well as equity. I see this backlash against grants. It's like, oh, we don't want grant-funded entrepreneurship. Actually, I find that the only people that don't want to put the only ones we don't want to give grants to are the diverse founders. And we need to do that just as much. We need to democratize access to the innovation ecosystem that we have. So those are a couple examples. And the last thing I'll just say is we need to actually give grants to support founder salaries. I want to say something that nobody wants to talk about, is that we're asking the top female and leaders of color to jump into entrepreneurship and make 10% of what they would make in a corporate job, and to work 20 times harder to raise any capital. And it's really, really not equitable. So we've actually given some grant funding to help the best experienced PhD talent, experienced CEO talent jump into entrepreneurship, and those are the ones who are going to build the next great company. So I think that's another ecosystem tool that if anyone wants to talk about, we're very passionate about.
Love this. So what I'm hearing from you all, I heard examples when we talk about ecosystem work around convening, connection making, policy advocacy, stakeholder engagement, and a lot of, I know in addition to some of the examples you all shared, there's a lot of thought leadership that you all do. There's continued sort of convening that you do at a bigger scale. I'd love to hear a little bit more about each of your roles that you're playing sort of in the ecosystem, and maybe talk a little bit more about that and why this work is so important. It is often unfunded, it is unseen. You could take the easier route and just do your direct capital allocation work, but you've chosen to actually go the extra mile. So as you share a bit more about the roles that you're playing, also share why. Why has this been so critical as a choice for you as in the work that you've chosen to pursue?
Yeah, I'll kick it off. It's such a great question. If entrepreneurs are truly going to be the change agents of this world, then it has to include everyone, not just a very few. And second, if you look at our biggest problems in this world, they're also our biggest markets as well. And so I've spent a great deal of time, really, I call it education, regular cadence calls with these multi-stage story franchises, because I truly believe wholeheartedly with the utmost conviction that inclusive investing, this five-pronged market-back approach, when we are diverse managers, we will organically over-index our allocation more on women and people of color. When we earmark our traveling dollars and our capital, there's great entrepreneurs in the middle of the country, in Detroit, in Houston, but also recognize that Silicon Valley and New York will continue to be the innovation hotbed. But we're doing ourselves a disservice if we are not embedding equity at the center of how we source, how we invest, and how we scale these projects. And so I don't care if you are an emerging manager or you're a storied franchise, if you implement, and this is where I just had the most up-close conviction, if you implement this inclusive investing strategy, NEA, Greylocks of the worlds, we will see a great deal of improvement in terms of how we democratize access to capital and truly sourcing companies from every angle in this country and the world. And so it requires some proactiveness. It requires, I was on the phone a couple weeks ago with Scott Sandell. Scott Sandell is one of my biggest mentors at NEA, and he is at Nasir. I got it wrong on the talent front. Obviously, NEA is one of the most storied franchises, but he said, Nasir, the way you're thinking about it, and there's a part of, hopefully, it's not obviously public and nothing like that, but it'll be, I can't wait to see a more proactiveness in a firm like NEA and a company like Carlyle Group. David Rubenstein was another that came, was an early supporter in Zeal. And it's just, I'm hopeful, I'm optimistic because there's folks like us, there's partners like you. And I do think over the past 5 years, you've seen obviously a more proactiveness in terms of how do we democratize access to capital, whether you're on the LP front or the GP front or your ecosystem leader, running venture studios, for example. That's really getting these entrepreneurs who have bold ideas, capital. And to your point, Lyndsay, the through line that I heard from you is that venture capital is actually not the best capital for every entrepreneur. It's non-diluted, save your equity, Philip, and I do think venture capital does have a role, obviously, because we have it allows us, these companies, to truly scale, given that we're injecting, a great deal of capital. For us is $1 to $6 million in equity investments, and so, but there's some early, in the early of a company, there needs to be other pathways to capital. But my whole point is that there's other more storied franchises that need to be in this room, honestly. And there's been a great, lots of just regular cadence calls, having those calls with these storied franchises. And so I'm optimistic that there will be more diversity at that front, but because there's a lot of unlocked capital on their side that they have that we don't have. So I'll pause there, but that's yeah.
And maybe to build off of that, I thought after building my last company, I would build another company. And I spent just a few years angel investing, and a lot of my former employees were starting new companies, so I would write an angel check in them. And one of the things I noticed was just, like I mentioned before, the African and female founders trying to build companies just couldn't raise meaningful money. They couldn't then hire great world-class talent. And so they just kept falling further and further behind. And so I joined a VC fund to learn about investing. And one of the things I realized is the 2 and 20 fund model, the idea that we're going to raise a fund and then 2% of the fund is the management fee. And we have to build a team that does all the investment work and supports these companies for 2%. I can just say it doesn't work in Africa. I don't know. I'll let the folks in the rest of the panelists say if it works here. And I actually went back and looked at the history. And if anyone, I don't know, maybe someone here knows the story, but it was a bit of a random reason that it's like a 2 and 20 fund from it was like this one investor decided that was right, and it's stuck, but it hasn't changed. And that's really how most LP capital flows. And when I started to dig into this, I'm like, we need to support entrepreneurs more, and we need a team of experienced operators to do that, and we can't do that on 2%. So to answer your question, we built Delta 40 as a venture studio and a fund because, one, we need some of that LP capital that only knows one way to flow in, but we need other structures alongside of VC funds to help provide the support these founders need to really succeed and for the fund itself to succeed. And I'll just be really, honest here in this room is that it has been excruciatingly difficult to find anyone to invest in the venture studio. Excruciating.
Lyndsay, are you suggesting that it should not be 2%? It should be 3%, for capacity and infrastructure and building talent?
To be honest, actually, a good friend of mine in Nigeria who's been at this was doing Intel's CVC arm and built his own 3 or 4 funds. He thinks it should be a budget-based management fee. Let's forget, because 3%, in Africa, an early stage VC fund, which is where you can make the most money, which is where you want to be, to be honest, pre-seed, seed, first check, that could be 10 to 20 million. So 2%, 3% doesn't even, no, 3%'s not even anywhere in the ballpark. So if we think differently, though, and so what we did at Delta 40 is we actually have a venture studio. We raise grant and equity into that, and we earn common stock for our support, but it's way more than 2%. But I think it will be sustainable. But we've had to try to build a new structure. And I'll just say, I think one just takeaway for me and a call to action for the audience is we need to challenge the traditional investment structures if we want to do things differently in the ecosystem. And I think it's time to do that, because I don't think the 2 and 20 model is working in many parts of the world. So there's a moment here. How can we in the SOCAP community, I've been coming here for over 10 years, how can we rethink the 2 and 20 model with this community, try new models, test new models, and really come out with a couple different structures that work to support the ecosystem? Because I think if we do it right, it will have ecosystem effect for all the other funds. If we can build more pipeline, all the funds benefit from that. If we build companies that succeed, the co-investors benefit. So I think there's a moment for, it's just, a moment to try something different, but we do need a lot more support to do that.
Can I just hop in here? So I loved what you said, Lyndsay, because it reminded me that we cannot move faster than the capital. Right? We cannot move faster. We have great ideas. A lot of us, we've scaled very quickly, but we cannot move faster than the capital. And I love that you just had a call to action, because right before this session, we had for the first time a GP-LP matchmaking happening at SOCAP. I see a few faces. If you were there, raise your hand. Let's see. Great. You know what's exciting about that? These LPs that were in the room, they've committed to writing checks by March of 2025. No spectators, no tourists. They're serious about it, right? And that's what we need. I liked what you said as well, because you talked about, we need different types of capital. We were talking earlier before the panel started, and reminded of the fact that when we started the engagement with Skoll, they asked a question like, hey, where do you need the capital? Is it on the grant side? Is it on the fund side? That's a great place to start. And it's great that they're able to allocate to both sides, right? But that's a great place to start if you're looking to invest, and it may be a grant, it may be a fund investment. And something else that we see happening in the space, and I don't know if it's radical to call this out, but it's a lot of time wasting. A lot of time wasting. And something I was reminded of earlier is that when we started our engagement with JP Morgan, they're funding our accelerator, currently one of the funders. It was 2 meetings before they told us yes. That's like unheard of in raising capital of any sort. You have to go through all these iterations, lots of time wasting, lots of FOMO. Who's in? Okay, if they're in, then I'm in. It's just like, let's just decide. I'd rather you tell me no early than tell me maybe for 5 years. So I just wanted to call that out, that we have some best-in-class partnerships. And then to help you out, Lyndsay, on the grant side, the gold standard is multi-year unrestricted. Yes. Just saying.
Go.
No, go ahead.
I was going to say, we've moved into my next question, which is what is needed to do ecosystem work, which is great. And let's just keep on that thread, and also why this continues to be important.
I mean, so for us, the story of the spectrum of capital is the story of APIS and Heritage. So, I mean, A&H that you see today is birthed out of grant funding to the Democracy at Work Institute. We were started at a nonprofit. My partner Todd worked there. I mean, literally, to Nasir's point, Todd and I are not well-to-do. So we did not have the capital to go out, spend 18 months taking a bunch of no's. And so literally, grant funding is what allowed us to be able to put hours against this without, we already had to ask our wives to do sacrifice, but at least we could be like, hey, you don't have to sacrifice everything. And so that was the unlock. And and I mean, it wasn't like a gazillion dollars of grant funding. It was enough to get us going. And what that turned into was that leveraged now $58 million that's being put to work and has already moved $65 million of assets to workers of color. So that's the power of grant funding. But that's what it takes. I mean, I think, even now, our portfolio companies get to work with Dowie on what we call ownership culture. I mean, if we just show up to a company and say, hey, you're a worker, you're an owner now, that doesn't mean anything. So we have to get you to feel like an owner so that you'll work harder, so you'll understand what a balance sheet looks like. But we don't have the time to do that. I have to go out, find new deals, build a team, scale a firm. And so it is actually nonprofit funded by some of our investors to have experts go to our companies and work with these companies week by week on this ownership culture work. But again, this is not we don't have management fees for that. Yeah. We have grant funding for that. And so this idea that like, especially the early stage, funds are able to make it work on a shoestring, and don't get me wrong, I think everyone up here is a phenomenal entrepreneur and is gonna do whatever it takes to build their firms. That's a fact. But I think recognizing that full spectrum of capability, whether it's a grant, a PRI, or MRI, all of it matters. And so wherever you can play, there's a space for you.
One of the things we talked about in prep for this conversation was, as we look at the spectrum of capital that's needed to do this ecosystem work, the importance of it, you all are doing it because there's an urgency. There's a sense of we've got to rise to the scale of the challenges that we're trying to solve here. We talked a lot about measurement and evaluation and the challenges that come in sometimes doing this ecosystem work when you can't draw a direct line to attribution of outcome, right? It's a lot of contribution of outcome. Can you all talk a little bit about that and maybe examples of where you've been able to demonstrate that contribution in a way that has resonated with supporters, funders, allies, that has helped people maybe shift their own thinking?
I'll take a stab at it. So to date, we're about $183 million in total AUM, which gives us a great deal of fees and just operational capital to build the best support system to support these entrepreneurs post-investment. And every investor says, oh, we're going to be more than just capital. But there is a point where you have to be honest with yourself. Philip, you touched on just the capacity. Like, we just honestly don't have the capacity to do every and all things. And so we know what we don't know. So we've really just been credit my head of portfolio management, Susanna Burge, and being thoughtful around building a portfolio post-investment framework. And you have each of these companies that are, maintenance check, they're fueling up or taking off, and then some may call it red, yellow, green. It depends on how you view your managing the health of your portfolio companies. And we recognize where our zone of genius. I mean, it's something we talk a lot about. What is our zone of genius to our entrepreneurs? It's helping them with their go-to-market strategy. We have an engineer helping them with their technology, getting into version 1 to version 2. It's talent, and of course, it's ecosystem, and introducing them to investors up the capital stack. So those are the things that we spend a great deal of time on with the founder. There are areas that we're not great at, and we're transparent in the midst during our diligence process. And so, as we think about, and even from an impact perspective, one of the beauties, what I love about early stage investing is that measuring the impact is embedded in the DNA of the business. Nothing against Vanguard and BlackRock and all these other firms who are trying to be very intentional and credit, but I doubt, I find it hard to believe that the company and the thousands of employees it's just ingrained, mission and impact is ingrained in that business. They've done a lot for our ecosystem in terms of from a financial perspective, but the beauty of early stage investing, even if it's not as clear cut in terms of the impact they're making. Isuzu is a great example, right? If you are part of the Isuzu platform, you're a tenant, your FICO score increases on average 114 points. And that is huge in terms of, especially if you're a low wealth family that's looking to purchase a home one day. And so that's an easy, obviously, indicator at the early stages, and that is obviously scale, just given where they're evaluated and how fast the business has grown. Same goes for other companies as well. And Seguros is another great company that's rethinking the insurance business for Hispanic communities. And so it's difficult to signal where the impact, but at least you're intentional, and our limited partners, you mentioned stakeholders, that's what they're looking for, and hopefully you see that scale over time as throughout the firm's life cycle.
For us, there's a few layers of impact. So one, there's the financial, and then there's the social. On the financial side, just context of the sort of companies that we're investing in, or the backers, the entrepreneurs that we're investing in who buy the companies. These are what I would call recession-resistant companies. Why that is important from a financial metric perspective is that when we look at the companies that are, for example, the Black community, the businesses that are typical in our community, they're not recession-resistant. And so what we mean by that is if a pandemic comes through, if COVID happens, if a recession happens, will your business survive? Will your business thrive? An example of that, insurance. Can you name a business that doesn't have insurance? It's very hard to, right? Another example, landscaping companies that have contracts in HOA. Whether the economy is doing well or not, that grass has to be cut. And so these are businesses that are, to some degree, sleepy, but are churning cash flow. And so when we look at making an impact from a racial and gender wealth gap perspective, we want to ensure that your business is such that irrespective of what the economy is doing, you can be successful. And so that's on the financial side. The typical, from an investment framework perspective, we're looking at businesses that are at least 5 years old, that have at least 20% EBITDA margin. We like to see at least $1 million recurring revenue, low CapEx. So these are businesses that are doing well. And then on the social side, as I mentioned before, our focus is on the gap, and we want to make sure that the gap is addressed in our lifetime. And so what we're tracking, obviously, is the cash flow of the business, the wealth that the entrepreneur is generating from day one to 5 years post-acquisition. And then we're also tracking other ancillary metrics. So for example, are our entrepreneurs owners or renters? Do they have a history of incarceration for themselves or their families? Are they first generation? Are they immigrants? Are they DACA? Like, these are some of the things, what is their household income? So that we can know, as I mentioned in my earlier panel, that the words on our website align with the lived reality of our entrepreneurs. And so that's what we mean when we say impact.
Yeah, so the question of, what is the impact of the ecosystem work? I think some of it is easy to measure and really exciting, and others in our ecosystem are hard, but I'll give two quick examples. So we feel our entrepreneurs could really benefit from subsidies or low interest debt. So in Africa, debt interest rates right now are 25 to 50%. And entrepreneurs serving the lowest income people in the world are expected to make VC returns with debt that at those rates. We've done some studies to show if we could just make the interest rates in Africa what we had in America when we go through these booms, right? It was 3%, 6%. Everyone thinks 6% is so high. We would die for 6%. Anyone that wants to do 8% in Africa, come and find me. But we did some studies to just show what would these businesses look like. And if you could just take the interest rate in Africa from the 20s down to 6%, those businesses would reach 5 times more customers. So just to put give you an example, a company selling a clean solar home solution to a family that uses kerosene today to light their home. They get a solar system, they have phone charging, a radio, television, the ability to power a mill, a clean cooking product. You can, for $20, give a subsidy or lower the interest rate by some $20, and 5 times more people will be able to afford that product and pay for it, still pay for it in a market-driven way, but 5 times more people. I mean, to me, that's just stunning, like $10 to $20 subsidy, and the impact that can have. And so we try to study that so that we can bring those numbers to the impact investor. So anyone with low interest debt or subsidies that want to have a big impact to Africa, it can go a long way. Then on the other side, we gave a $50,000 grant to a Kenyan female founder. She had a PhD in microbiology. She built novel ethanol businesses in America for 20 years. She built a company that flew a Delta Airlines plane on bioethanol. Her name's Dr. Linda Davis. She sold her house in San Diego where she made about $250,000 to $300,000 a year, and she moved it back to her home country of Kenya to build the first bioethanol facility in Kenya because we have all the technology we need. For 3 years, she tries to raise capital. Nobody would invest in her business. Not one person, a PhD, to tell me there's no pipeline. We found her. She was at the end of her rope. She was doing 6 consulting jobs just to pay the bills. And we ended up giving her a $50,000 grant and a $50,000 equity investment side by side if she would focus on the business. And we gave her health insurance. She had 2 kids. She needed health insurance. Very simple thing. We gave her health insurance, $100,000, half equity, half grant. She quit her job. She focused full time on the business for the first time ever. And today, she's raised over $3 million. She's launched a $25 million project finance round that has about 7 interested investors. And you know, she talks about how, you know, she as a mother, you know, she was finally able to kind of build this company with dignity, though, and be at home for dinner. And so a simple $50,000 salary. And a little bit of capital to prove out that she was capable of doing this. And so I don't know how to measure that, right? That's the one where you just say, this is money well spent.
Yeah.
So those are 2 examples.
Yeah, I mean, for us, the North Star for us is very clear. It's wealth in workers' pockets. And so we can measure that because every year, every single worker in every single company gets a piece of paper with their name and the number of shares that they own. And that's powerful. I mean, many people don't even really get that they're an owner until they see that piece of paper. And today, it's not huge dollars. You're not like an overnight millionaire. You've got 4 figures, but you were making $12, $13, $30 an hour. That's big. And if you stay with the company, that could turn into 6 figures. That could turn into 7 figures. That's what we're trying to see. So our true impact won't be seen for 2 generations. When you see someone who's like, oh, I'm a startup founder and I got my friends and family around and now I came to see Nasir. Oh, where'd you get your friend and family money from? Oh, my uncle worked at this company that was employee owned and retired with it. That's powerful. Oh, I got this down payment for my house because my aunt was a nursery worker at this company that was employee-owned. That's what we're trying to get to. And so it takes time to get there, but we're on the path. And I think and then to the broader ecosystem point, there's nothing like an idea whose time has come. And employee ownership as an idea has come. And so our job, why we spend so much time in the ecosystem, is we have to change their narrative. We have to get people to realize that this is a real thing and it can happen. And you're seeing it. Like you saw KKR do employee ownership, all the big PE shops. Now, I'm not saying we did it first. but we did it first. But it's a great validator. Like they're great guys. But they think it's a great investment thesis. So do we. And so, again, you know, right now there's 250 ESOPs done a year. We needed to be 2,500. We needed to be 25,000. We need to tell the story from the mountaintop. And so that's why we do it.
Could I ask Philip a follow-up?
Before you ask the follow-up, I just want to say we're 2 minutes to questions. Actually, we're going to start Q&A. So there's white index cards going around. Please use them to put your questions in, and then they'll be aggregated up front, and we'll go to Q&A. But please, Lyndsay, go for it.
Yeah, but so just a quick follow-up is that I find that a lot of people who do ecosystem grants and building work it's very hard to talk about wealth creation when you do that. So I just wanted to open an honest dialogue that we sometimes, we're at Delta 40, we're passionate about building wealth of our founders, but if we say it, it can sometimes prevent us from getting grants because the grant makers don't want to be seen to be creating too much wealth for someone. So I just honest question, right? Like how do we talk about the need for this and still get grant money flowing into this, but not scare the IRS or the grant funders? That's a real barrier we've had.
For us, I think we were very fortunate in that our first fundraise had a lot of great foundation capital who came in the form. A lot of them were PRIs using their grant dollars to make an LP investment. But one thing we learned in that process, and I'll share this with any fund manager. So by our docs, it says we have to invest in companies that's whose workforce is low and moderate income as defined by the IRS. And when you do that, it gives clearance to a foundation. I am not your lawyer. I am not your legal advisor. But if you do that and you were to consider that, many foundations and the IRS can recognize it. And so that's been our...
Awesome. Okay, we're going to open up to questions. Do we have any that folks have shared back to Andrew? Anybody need a card, or you can come up here and grab the mic.
Yeah, it's a really good question.
Yeah, please.
Let's do it the old-fashioned.
I'll repeat it.
Can you explain or expound on further why you think ESOPs are an idea whose time has come?
Okay, so the question is, can you expand on why you believe ESOPs, this is the time has come for ESOPs?
I think you're seeing it across the stage. There has to be this sort of reimagining of capitalism, the economic order, whatever word folks want to use. I mean, we've sort of just seen that the current structure works, but it works for people. I mean, that key word is capital. So if you have capital, you've been doing extremely well. But what it's created is this sort of dichotomy. And I think now we're starting to see that we're at this moment where, like, climate has become this existential crisis. And I think now there's this growing recognition that inequality, it's on its way there. Like, a lot of the work around, democracy is, I think, a play on the lack of equality. And so I think now people are recognizing that new models, new ideas, new ways of investing are needed if we're going to solve that gap. Because people forget, the capital markets is a $3 trillion apparatus that is not built to help working folks.
All right, I got a question up here. It's a two-parter, or maybe a three-parter. Describe great LP leadership. What do they do? Do they anchor? And describe great LP followership. Fellowship?
No, that's
The jugular, go for the jugular.
So there's so many.
Everyone here is a part of the ecosystem. Reminder.
LPs, it's different. One, they have, so I'll give an example. It was very public out there, Barclays. Barclays, we manage $50 million on behalf of Barclays. It's their balance sheet capital, not foundation philanthropic capital. And they said, Nasir, we want to invest 100% of this capital to technology, mission-driven technology companies that have at least one black founder on the management team. And at first, that was it. And we say, this is $50 million, and we're investing pre-seed dollars. This is also an opportunity to shake it up a little bit, and let's invest in the next generation of GPs as well. Not those who are currently building out their firms today. These are particularly black functional experts. These are executives and ecosystem leaders, those who are functional experts, engineering, functional expertise, who are also proximate to black founders. Couple that with Zeal, essentially building out a Zeal masterclass on how to source, how to conduct diligence, how to write investment memos. So when you couple this idea of functional expertise with investment acumen, them being black functional experts, and this broader idea around, let's diversify those who are in the seats of deploying the capital. This is my team coming to Barclays saying, look, $50 million is enough dollars. Let's at least carve out $5 million. So this is a great example of being collaborative, being open, because they don't know the venture capital, and because they're all Series B and beyond, pre-IPO, and obviously looking for strategic investments. And so I was just taken back. I think another great, I think we would all agree here, is as a limited partner who runs a clear process. Number two, one who is open to just regular cadence calls. We want to continue to build that relationship. And number three, mainly for an institution, asset manager, family office, private foundation, those who bake in like Skoll and Gary Community Investments, it's a great example, who bake in not just being involved in Fund 1, in our case, but also baking in Fund 2 and Fund 3. And so that shows that they're with you not just for 10 years, and depending on when you go out back into market, maybe for the next 30 years, because every fund is a 10-year legal life cycle. And so that's clear. What hopefully the through line all of you heard was collaboration, was transparency, and this idea of just being open to new ideas and them knowing what they don't know, hence why they invest in GPs like us.
Awesome, thank you. I'm going to keep going with the questions until I get pulled off the stage. Allegra, tell us more about your foundation work with fellows.
Oh, sure. Okay, so we have a 501c3 that runs our accelerator. It also runs 2 other programs, Succession Ready, which trains existing business owners on the process of selling their business, typically owners who are 5 years or less away from retirement. The last program that our foundation runs is what's called the PAL Fund. It's a pre-acquisition loan program, started with capital from Common Future, where we underwrite loans for entrepreneurs at 0% interest, need-based, up to $40,000 for entrepreneurs that are acquiring businesses to help them with the pre-acquisition costs. So things like, diligence, hiring your M&A attorney, et cetera. And so that's been very catalytic, as you can imagine. That fund is 100% allocated. And how that works is that we underwrite those loans. In 30 days of closing, the entrepreneur repays us, and we're able to give that capital back out. It came in at 0, and we're giving it out at 0. And so that's just one. The biggest chunk of our foundation work is Beta, which is a 10-week hybrid accelerator. First half of it's focused on training you on how to buy the business, so valuation, finding the deal, creating your investment thesis. And the last half is focused on running the business, so scaling, HR, marketing, ops, technology, et cetera. And so that's the work that we're doing. We're launching cohort 7 in DC. Applications are currently open until November 15.
Awesome, thank you. Okay, we have another question on ESOPs. Can you share more about the potential government support for ESOPs and where that is right now? Some of the terms that came up were SBA and SSBCA.
Yeah, I think, actually the 7A program used to be restricted from ESOPs. And I mean, the quick story, it's a great lending program, and it basically allows the federal government to backstop a bank loan. The trick of it was you had to personally guarantee the SBA loan, with the one exception now in the regs, unless you're an ESOP. And so what it does is it allows employees to transition to business without having that personal guarantee requirement, which opens the door now for more ESOPs. I think there's still a lot of, these are regulated transactions. The Department of Labor is highly involved. And so, but now DOL actually has someone in the office of the regulatory body who is advocating, supporting, trying to support employee ownership and specifically ESOPs. So that's brand new. And then on the policy front, it's fascinating. Kamala Harris has actually come out and said, hey, we want to do something around employee ownership and the tax breaks. What people also don't know is, if you read Project 2025, there's also lines about ESOPs specifically. So this is the most bipartisan idea I know about right now. And so, but that said, but to the point of the time has come, it just shows that, like, however your views are, you can get behind this one way or the other.
And Philip, before you put the mic down, there was a question on, can you just explain what an ESOP is?
That's a great question.
And what it stands for.
I am so sorry. So it's an employee stock ownership plan. The idea is, spare me the legality of it, you're going to basically take the owner's stock, you're going to put it into the trust, and then you're going to make all the employees beneficiaries of that trust. And so over time, they're going to accrue those shares. The real power of it is there's the last great tax break. Any company that's 100% employee-owned does not pay federal income taxes. And in 44 out of 50 states, they do not pay state income taxes. And so when we invest, we're taking a company that was a taxpayer and effectively making it no longer a taxpayer, using that capital now to pay down our capital, generate return, grow employees, et cetera, et cetera.
So just want to build off that too. We recommend all of our companies give employees ownership, and we've had multiple investors not invest in those companies because the cap table is too complicated. So my last company, we had 330 Ugandans that were part of the ESOP. So I just want to put a call out too to investors to not be afraid of cap tables that have a lot of employee owners. They are managing expenses and driving profit, and we shouldn't be afraid of those kinds of cap tables.
That's right.
Another question that came just in the spirit of being inclusive in this room, can someone explain what an LP is?
Great question.
I thought that question would actually come up. I'll take a stab at it and then just add something about the LPs in Africa. So LP is an investor in a fund, or a limited partner is what it stands for, but I did not know that before I launched a fund as well. So, and I think just one thing that I've seen, so there's a lot of LPs that I think they're really well-meaning in saying we want to invest in emerging managers. They want to invest in first-time female fund managers, managers of color, and sometimes the very first question we get when we're in diligence is, can you share your track record? And I just kind of want to say that's really confusing. And a first-time fund manager doesn't have a long track record unless you're independently wealthy and you can do angel investments. And I just want to say, it feels like the rules to be a fund manager have been created to kind of make sure only the people who are fund managers can be fund managers. Oh, you must have a track record to be a good investor. You must be able to do the GP commit of 1%. So if these are rules, then white men will be the only investors in Africa for the next 20 years. I just want to say to the LPs in the room or people helping first-time fund managers is we need other proxies. Like, for example, did you build a company and sell it? That's a really good proxy, I think, for knowing how to do that, how to find really great founders. Or maybe, for example, they could pay for first-time fund managers to go to the Kauffman Fellowship and learn the best practices of VC. So I've found the best LPs in our space trying to do this work are the ones who actually work with first-time fund managers to kind of get the track record they need without a loan. I don't want to take a personal loan to build my track record. I don't know about anyone else, but I have 2 kids that I need to put through college. I think finding creative ways to help first-time female fund managers get the skills they need, complemented with the unique views they bring, are the most amazing LPs, and there are some really great LPs that are doing all of this kind of innovative work around first-time female fund or first-time fund managers.
If I can just build on top of Lyndsay, so LPs are the money behind the money is another way of viewing it as well. They can be individuals, family offices, private foundations, university endowments, sovereign wealth funds, pension funds. These are banks. These are accredited investors, which is obviously another definition. We can go into that if you like. But I'm with you. There definitely needs to be some shaking up in terms of the 1% commitment. Whew, as a first-time fund, I mean, I had to get really, I had to be really unique in terms of how I showed that I had skin in the game. And essentially what they want to see. They want to see that you believe in your strategy just as much as they do. And so, so plus one.
There are some good loans. I've seen some really cool things where they take the GP commit out of your bonus for the first couple of years, so that can be a more equitable way to show skin in the game, or part of your compensation can go towards that GP commit, which I think is quite cool.